The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho with Steve Sedgwick, and these are your headlines. The bond market sell-off goes global, with benchmark yields rising in Japan, Germany, the UK and the US, where the 10-year yield hit its highest level since April. Deflation concerns continue to dog the Chinese economy, with consumer prices hitting a 9-month low in December, while factory gate prices remain in deflationary territory for the 27th straight month.
President Biden reportedly readying a final round of restrictions on AI chip exports before leaving office, looking to force allies to align with US standards. And the deadly Los Angeles wildfires spread into the Hollywood Hills, with President Biden declaring a major disaster and cancelling a trip to Europe. Very good morning. How are you?
Good morning. Very well, thank you.
Good. We have as a top chat, it says here, top chat bond sell-off. Well, and it was our top headline again today as well. But the fact of the matter is, there are many reasons why bonds sell off, and there are many reasons why we are seeing this bond sell-off at the moment. So a 2 or 3 minute chat at the top of Squawk Box will not suffice. But the good news is, this is something we've been talking about for years. It's something that we've both tried to impress upon central bankers and finance ministers, that this is a clear and present danger. And for most of the time that we've been trying to bang on about it, we've been batted away. Only very recently, I tried to raise this issue with the Bank of England, and yet again, there was not a dismissal, but it was kind of like, this isn't the key danger now, and even if it were, we don't know what some of the risks of the Trump administration incoming will be, ergo we can't respond. And yet the danger is there. Because, we talk about valuation on the stock market. Let me just make one point here and you come in. When we talk about valuations on stock markets, we talk about, okay, they're much higher, ergo there's going to be more volatility on slight misses or beats and what have you. When you've got thin air at the top of the mountain on valuations, it's much harder to impress. And I think that's the same with the debt levels of the sovereigns around the world now. When you have more debt, then the bond holders and the potential bond buyers are going to be more discerning. Ergo, when you have slight hiccups or concern about inflation or concern about growth or concern about whatever it may be, it creates more volatility around the underlying asset.
Funnily enough, we had a bond auction that landed well yesterday, the 30-year, despite the heat that we're now seeing at the very long end of that US curve. So the bond auction that the markets were watching got away okay, but I think the underlying concern now is one that has been there for a long time that nobody's paid attention to, that if a government has an issue with the electorate, it spends more money. The government has an issue with the economy, it spends more money. And we're not just talking about the US economy here, we're talking about all the different ones that we mentioned in the headlines where there is an escalation now in the yield. And the answer to some of the problems that may be reforms, might be tough medicine, that has simply not been something that populations or governments have been willing to engage with. Hence the steady stream of deficits that we've been talking about for years. Even when you have an expansion cycle, we're still seeing governments run deficits. I mean, when in history, if you think back 20 years ago, when would we be talking about running deficits when you had economic expansion? But that is simply the way, the playbook for economies these days. But it comes at a cost, and that cost is eventually the bond market wakes up and says, look, that is not comfortable levels for us, and we're going to react. And hence you're seeing that reaction at the long end. In terms of what central banks do here, and we saw it in the minutes yesterday to an extent, where the Fed was looking at some of the big policy endeavours of the Trump administration, trying to recalibrate for what's ahead for 2025. And the big takeaway word was careful. They're now careful about whether we're talking about more inflation coming into the mix at a point where Trump was talking yesterday as well that the interest rates are too high. So where do we go from here? Pain pressure from the bond market. Typically, that is not positive for the stock market. Well,
whilst the Federal Reserve is still independent, which we think it is at least until the end of Powell's term in 2026, it almost doesn't matter what Trump thinks, because his policies will dictate what the central bank can do while it remains its independence. But I want to just add, there's nothing wrong with a bit of inflation. A little bit of inflation is great. Central bankers think they know how to deal with it. Deflation is what they spend most of their time in terror about as well. But bond market yields go up for two reasons. One, because your economy is doing really well. Two, because your economy is doing really badly in some ways, i.e. those debt levels you were talking about, recessionary fears, concern about more issuance to cover, as you say, the lack of growth elsewhere, to cover your interest bill and to cover your ongoing expenses, which is where the UK problem. So
fiscal spending that can actually be contractionary, which we saw through the Italian story several years back, which was extraordinary, that if you spend money, you typically get the growth. But the bond markets were saying if you spend money, it's actually going to contract the economy.
Depending on where you're spending the money. If you're spending it on investment and growth and restructuring the economy, that's one thing. But if you're spending it on your interest bill, it has zero bang for buck. You don't get anything by spending more because you have a higher interest bill, which is what Rachel Reeves is finding the problem here. But the US is the most nuanced of the lot. US bond yields are going up. One, because of obviously concern about supply. Two, because of concern about Trump policies. But three, and this is the other point that we should raise here, the economy's going great. There was lots of data in the last 24 hours. Lots of data, and we had ADP, and we're looking at all kinds of stuff, and by and large, it was still the confirmatory, robust jobs figure. But for instance, did you see revolving credit? Overall, consumer credit fell 7.5 billion, and revolving credit plunged as well. So Americans who are keeping their jobs, who are seeing pay rises, which is most of you who are in employment, actually cut their debt levels aggressively. I look at revolving credit every single month because I think it's a really interesting barometer on the pain on the balance sheet of the bottom half or the bottom third as well. And overall, Americans repaying their debts and reducing their consumer credit level compared with previous months. That's a really robust sign. So the other thing about US bond yields going up is that actually the economy's in a decent place.
Which has been the market assumption, but the Fed minutes yesterday was talking about trying to ascertain, what's coming and some of the placeholder assumptions. They're saying, look, real GDP growth was projected to be slightly lower than their previous baseline forecast. Unemployment rate was expected to be a bit higher. So that doesn't really match up with some of the market expectations of higher growth than expected this year, thanks to a Trump administration. I thought that was quite fascinating.
That's not necessarily the bit that I took out. I took out from this that actually they see the jobs market as a pretty strong place, and ergo, they do not need to have an aggressive pace of cutting from here, because actually, by and large, and I take on board what you said about maybe slightly low on the GDP, we're still talking about a two-handle GDP. I mean, there's Europeans who would bite your arm off for that.
Yeah, just final point here around credit costs, and we know every time you go back to the market and you're trying to raise funds, if you're a company or business, then if it's more expensive, then it has some bearing on the cost of doing business. And we've been talking a lot about refinancing, but the longer higher interest rates go on for, whether it's market interest rates as well, it puts more pressure on businesses. And to me, what was fascinating was the speed of escalation. It's not necessarily the level you get to, it's how quickly you get there, and what we've had on that 30-year yield. And keep in mind, this is the safest of safe ends of the market as we talk about long-term debt here in the United States. 60 basis point escalation in a month, so taking us to that October 2023 level. So it is the pace that we're watching out for from here. Now, you can see those treasuries and the 10-year as well, where we're perched. We are seeing a little bit of a drift in the morning session, 4.66%, but really the next stop is going to be that non-farm payrolls report and what the bond market does with the latest jobs numbers. Global bond yields also being moved in a direction along with those treasuries. You can see that treasury yields, and across the rest of the board to German bonds, we're 2.52%, the JGBs 1.17%, and the 10-year gilt 4.80%. So all these different trades have been pulled higher along with the rest of those markets. So it is a strong trade all round across the board. Let me take you to those US markets. As a result, we are seeing some fade coming to those tech stocks. They had early in the week been a real standout play for 2025, where investors were just brushing off a playbook from a couple of years prior and really racing back into some of those big name tech stocks. But it is now seeing the Nasdaq reverse thanks to the bond market moves. We've got the Dow a little bit firmer, the Nasdaq also tracking in the green for the session. But don't forget, markets closed today. Now, in terms of the dollar trade, we saw the escalation of the dollar, and that started about 48 hours earlier as well. So that has meant euro dollar as a casualty, dragged right back to the 103 handle. We're 123.20. We slipped about 1% on cable yesterday. Dollar yen trades 158.14. also drifting, but dollar there versus a Swissy and just moving north. So it is a dollar is king story morning session. To the Asian markets in reaction to these bond market moves, it is a downbeat session for Tokyo stocks. So Japan shied 0.8 moving into the red, 0.2 down for Hong Kong stocks. We keep hearing about money being moved from Chinese investors across to some of those mutual funds in Hong Kong and chasing the bond market. The Shanghai Composite down 0.4, the Kospi fairly flat, slight positive bias.
So back to the minutes. Fed officials indicated they will be moving more slowly on interest rate cuts amid worries over inflation and the impact of upcoming US President Donald Trump and his policies. According to the December minutes, Fed policymakers highlighted potential risks stemming from changes in immigration and trade policy. US Treasury Secretary Janet Yellen told CNBC she is confident about the current inflation trajectory, as well as the state of the US labor market.
The rate of inflation has come way down. It's now pretty close, quite close to the Fed's target. So prices aren't continuing to rise at anything like that pace. It's now very close to normal. I feel pretty convinced that we're on a downward path and that the labor market is not an ongoing source of inflation. The labor market has cooled and is in a very similar good state like it was prior to the pandemic.
Well, as we were saying about the data, US initial weekly jobless claims fell to an 11-month low, down 10,000 to 201,000. Private sector job creation, though, eased in December, with ADP estimating that only 122,000 jobs were created. But net jobs were created. That's the point, isn't it? It was less than expected. Meanwhile, private sector wages grew at their slowest pace in 3.5 years. The chief economist at ADP is Neela Richardson, and she told our US colleagues that specific sectors in the US economy continue to be under pressure.
Pockets of weakness are something to watch. Manufacturing, as you mentioned, shed jobs for 3 consecutive months. That's concerning. This is a sector that could benefit from a rate cut. It's a very cyclical sector.
Right.
What's doing the heavy lifting in services is no longer leisure and hospitality. We think that game is over. It's really healthcare, and healthcare is not cyclical. It's tied to, I think, demographic hiring.
Neil Wilson is co-CEO at EJF Capital. And Neil, I really appreciate, by the way, you joining us on what is such a momentous day of national mourning in the United States as well. So I do appreciate you joining us early for this broadcast. Neil, we were talking a lot about various things, and I'm sure you were champing at the bit to get in on various things as well. Let's talk a little bit about the minutes. I think Karen made some great points as well. Concern about the economy, concern about Trump, concern about the risk going forward as well. But I did chip in there as well that actually some of the reasons why yields are picking up are actually very positive.
First of all, thank you very much for having me on today, and it's great to be with you in the new year. I agree with two things. One, that Karen said, I think the risk really is having a bond auction failure. That is the big risk that I worry about. Obviously, the 30-year auction went well. But I agree with what you were saying, Steve, in terms of I think the minutes reflect that the economy is doing well, and the FOMC members feel very confident that the economy is slowly kind of normalizing towards their 2% rate. And I think that's, what they were very hawkish in their tone, and there was a real about face in their SEP kind of statements from September to December. But I think at the end of the day, they're looking at the data, and CPI, PCE, the personal consumption expenditure price index, is still 2.8% core. So they're just going to try to, ease into this. They're not going to raise rates in January. That's crystal clear from the minutes. And I would probably say March is probably a hold as well.
In terms of what this means before we get on to broader asset classes, what it means for the bond market itself, part of me, and I had this conversation with a gilt analyst yesterday, is part of me thinks we've got peak worry about inflation, peak worry about Trump, lower bond prices, higher bond yields, peak optimism perhaps about the trajectory of the economy. Is this just the most extraordinarily wonderful entry point for sovereign bonds, Neil? Or is that just a little bit too relaxed? Because bearing in mind they're supposed to be defensive, they haven't acted particularly defensive, but is this just a great entry point?
No, I think it absolutely is, especially with stock valuations so high and peaking as you indicated in the fourth quarter. So I do think it's a great entry point. I do think it's important to point out that some of the concern is basically that Trump's tariff and immigration policies are going to cause the kind of inflation you don't want, as opposed to strong growth that's prompted by his tax cuts and his deregulation policies. So those are the two things that are going against each other. But I think what people are overstating a bit, and I call it a bluster alert. Trump can't really do as much on tariffs as people think. There's not a lot of consensus on the Republican side other than raising tariffs for China and some goods in against the EU. I think he's actually making more bluster than what he can really deliver, and I think that's going to become evident as the year kind of unfolds. I think the other thing I would say is important to focus on is, are we going to have one big beautiful bill, as Trump has indicated, or are there going to be two steps? One, immigration, which Republicans absolutely agree on, putting up spending money for the border kind of restrictions. But the tax and spend part, that's a little bit more complicated, and there's not exactly great consensus on all areas on taxing and spending on the Republican side.
One big beautiful bill is somewhat catchy. I feel like we're going to be talking about it for a while, Neil. But let me ask you more about the playbook from here, because it feels as though the macroeconomic forecasters were trying to plug in Trump variables for the outlook for the US economy, and that really was expressed through the minutes. What does that mean in terms of whether we're going to get 1, 2 or 3 rate cuts? And if it's so uncertain, does it really matter for the equity market that have been setting up for more reductions this year?
Well, I think the market, like you pointed out earlier, Karen, that on the tech side, that they've come in because it's looking like there's going to be higher rates for longer. I think what you can think about rates is that it's going to they're talking about 2 cuts. That's what comes out of the minutes. The market's telling you 40 basis points. The Fed's telling you 50 basis points. It's going to be in that range, and it's going to be more in the back half of the year would be the prognosis. So you have to expect that rates are going to be higher for longer, and in terms of the unfolding of this year, and that definitely doesn't bode well for tech stocks.
Doesn't, but Neil, I've seen other environments where the market is so uncertain that they're questioning which way the economy is going, and as a result they've placed all their bets in technology because they think it's immune from some of the fluctuations they're seeing elsewhere. Is it possible that those magnificent 7 stocks could be the safe haven again if the market thinks that they're setting up for a volatile period?
Well, they're definitely reliable. I mean, the Magnificent Seven are in a class of their own in terms of how much profit they're generating and excess capital that they can spend on research and development and so forth. So I think that's kind of the exception. But just broadly based, I think it is harder in a higher rate environment. I would make a plug for the banking space, particularly the small banks, just because they're in a spread business, right? And we've had lower rates on the front end and higher rates, as you've been discussing since the top of the hour on the long end, and that's what banks do. And small banks are domestically focused; they're not going to be impacted nearly as much as the GSIB or very large money center banks, which do have international lending practices and deposits, and especially in Europe, those are going to be impacted by the tariffs that Trump can get enacted or can implement, I should say.
There was a time back in deep, distant history when we were all a lot younger, let's say 2008, or 2008 to 2010, where an ATM problem in Nicosia sent ripples across the world to the States and everywhere else indeed. Nowadays, we have huge shocks coming and going, and nothing seems to really be the major factor coming from the outside into the US. And so we've talked a lot about US factors. Do you think any of the bond market stresses that we are seeing globally, and I'll use our own dear country as a great example of that as well, could have trigger ramifications, domino ramifications for the US, i.e. rather than the US looking out and saying, well, it's domestic factors here, is there any international factors you think, or international stresses that you think could actually lead to problems in the US?
Well, absolutely. I mean, as you indicated, we're all, or at least you and I, Steve, are old enough to remember the Asian bond, kind of flu that that precipitated problems in America and across the markets. But yeah, no, I mean, look, America's relatively strong, and so it's the discussion about China deflation. It's not really impacting the U.S. terribly much as it would have probably 10 years ago. But look, anything that happens in the sovereign market, any kind of auction failure, any kind of poor sovereign issuance, it absolutely can have a triggering effect. And so that's the black swan that I worry about is a treasury auction in the U.S. That would be the worst. But you can also have what you're kind of outlining, which is a triggering event in another country that does impact the U.S. It's happened before. It can happen again.
Neil, not only is it wonderful to see you on what is a momentous day in the United States, but your manners towards my co-anchor are quite extraordinary as well. I know for a fact that she was covering a lot of this stuff back in 2008 to 2010, but your manners were beautiful there. Well done, Neil. You are smooth as they come. Neil Wilson, co-CEO of EJF Capital. Karen Cho.
I can barely remember those days. Steve, coming up on the show, China flirts with deflation as consumer prices effectively flatline in 2024. We'll cross out more to Sam with more. Plus, deadly wildfires continue to rage around Los Angeles, now spreading to the Hollywood Hills and forcing more mass evacuations. And the US today lays to rest former President Jimmy Carter. We'll look back at his life and achievements with Sir Richard Branson, with whom he helped found the Elders Foundation. That exclusive conversation is coming up at 6:30 GMT. The PBOC will sell 60 billion yuan of 6-month offshore bills in Hong Kong next week, its biggest issuance of such bonds. This in a bid to tighten liquidity and fight depreciation pressures on the yuan amid a stronger dollar, falling Chinese yields and rising trade tensions. The yuan has steadied around a 16-month low against the greenback. Meantime, Chinese inflation crept up just to 0.1% in the year to December and 0.2% for the year, well below the country's 3% target. Meanwhile, producer prices dropped 2.3% year on year last month, the 27th consecutive month of declines. And let's get out to Sam for more. Sam, the Chinese story seems completely opposed to what we're talking about elsewhere, where bond yields are falling and inflation is barely materializing.
Yeah. Yeah, absolutely. Very good morning to you, Karen and Steve. China remains a global outlier on both of these fronts, with the deflationary pressures that it's continuing to show, and also, as you say, with those falling bond yields. In fact, as technical analysts have been pointing out, the only major bond market we're actually seeing yields tumbling. And I've been looking at also what some of the technical analysts have been pointing out and having a lot of conversations here in Asia about how we're seeing the crossover now between the Chinese bond yields, which have been falling, and now on the longer dated, lower than what we're seeing in the JGBs on the 30-year. And so many are watching with a lot of these expectations that we could be seeing the 10-year now this year at close to 1%, or at least inching towards that, that we could see a bit of a crossover on the 10-year with the JGBs as well. So something to keep an eye on. But no doubt what this is signaling is, of course, a safe haven investment, as you've been talking about at the top of the show, what it means for the bond market. And sort of what we're seeing globally right now, which of course is heading in the other direction, is that there is a lot of economic uncertainty, and this is sort of signaling the deflationary pressures. And we got more evidence of that today, as you mentioned, with the CPI and the PPI trend that's been persistent for more than 2 years now. I believe about 27 months or so of deflation now, what's paid at the factory gate. And then the CPI, as you can see here, which has cooled off since over the summer. In fact, we got the lowest reading for December since around April. So it's barely moved, really grown or risen last year. And really that just caps off what has been 2024 of continued disinflationary pressures here as far as sticker prices are concerned. You know, obviously we have the rising worries about overcapacity. These businesses, of course, that are struggling to compete. We're seeing the price wars that are playing out in the EV sector sector, and this is extending beyond just autos into other areas. And then, of course, that just feeds into the jobs picture as well. And then that obviously having an impact on consumption too. So no doubt that reinforces the need for more stimulus. And, this coming just a day after Chinese authorities held a very sort of, what has become normal now, but has been a rare press conference of various departments trying to expand the scope of some of these consumption programs. Now, we expected this to be the case. The big question now, well, there's a couple of them, the funding, where it's going to come from, hoping we'll get clarification at the National Annual Meeting of Parliament, and then the implementation, and then whether that will actually show up in the sales.
Sam, just quickly, it seems as though we've reversed back in time to Chinese being sensitive about the economic numbers and whether they're called out on them. There was a piece that's been running in the Wall Street Journal talking about Xi Jinping effectively muzzling an economist who's doubted those GDP numbers, suggesting that it wasn't a 5% handle that the country's growing at. It could be actually about half that. So just talk us through some of the sensitivities at the moment.
There's a lot of sensitivities, and the Wall Street Journal has been coming out with some fantastic reports in recent months, really trying to get to the bottom of the thinking here in Beijing with some of their sources who are sort of close to President Xi Jinping as far as his circle of advisors are concerned. And one of those is on the growth target. Now, he seems to be convinced that they're going to hit that around 5%, but there are some sort of bearish calls, even questions from Chinese economists, some of who are based stateside, who do question the numbers. And that has, of course, long been a controversy when you've been looking at China as far as just how transparent they are about this. But then also what I've been watching is some of the concerns around, the fact that deflation is clearly stalking China, but it doesn't seem to be keeping President Xi up at night. And that is something that the Wall Street Journal has been talking about as well, that he has apparently, reportedly, been saying, well, what's the big problem? Don't people like things when they're cheaper? So that goes to show what he's thinking of deflation, if indeed that is the case and what he said. And that is why it's sort of become taboo over in China right now. The D word, don't say that.
Great coverage. Thank you very much, as ever, Sam. Hopefully we'll see you a bit later.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.